Okay, we're back. And our next panel on financial reporting fraud is a staple of every securities enforcement forum. It's such a vital part of the SEC's mission. And the SEC has been actually increasingly active in this area lately. So this panel of real experts in this area will be a great way to break it all down. And let's start with our moderator, Steve Richards, who is a senior managing director at Ankura. Steve brings a lot of really unique experience to the table here. He previously served as an advisor to the PCAOB's Director of Enforcement and Investigations, as well as an advisor to its chairman, and also as a former assistant chief accountant in the SEC's Division of Enforcement. So thanks for moderating today, Steve.
Thank you, Bruce.
Next up, we have Bill Baker, who's a partner at Latham and Watkins. And Bill, of course, was an associate director in the SEC's Enforcement Division, where he worked for 15 years. And among the important cases that Bill handled at the commission was the WorldCom case, one of the largest financial frauds in history. Bill, great to have you with us today.
Bruce, nice to see you. Thank you.
From the SEC, we have SEC Associate Director Melissa Hodgman. Since 2008, Melissa has risen through the SEC ranks to her current senior position, where she has led many of the SEC's most prominent enforcement matters into financial fraud and other types of cases. So it's great to have her insights at this conference. Welcome back, Melissa.
Thank you, Bruce. Nice to be here.
Dixie Johnson is a partner at King & Spalding. Some of Dixie's best work is done behind the scenes. Since joining King & Spalding in 2014, the government has closed almost 30 investigations without charging Dixie's clients. She's also one of the first lawyers to get a call when board committees need to investigate accounting and disclosure-related whistleblower allegations. And one thing you may not know about Dixie is that she served for 6 years as a public school teacher in Albuquerque. Dixie, always great to have you with us. Thank you and welcome.
It's great to be here, Bruce. Thank you.
Finally, I'm very pleased to introduce Claudius Modesty. Claudius is a partner at Akin, Gump, and he's had a remarkable range of experience. Claudius started his career as an attorney in the SEC's Enforcement Division, then went on to be both a trial attorney in the DOJ's fraud section and an AUSA. Then Claudius, for nearly 15 years, was the first ever director of enforcement for the PCAOB. So Claudius, really look forward to hearing your views on financial fraud now that you're back in private practice, and welcome.
Thanks so much, Bruce. Glad to be here.
All right, Steve, take it away.
Thank you, Bruce. And thank you, panelists, today for making the time and spending the time to prepare for this and get ready for a really great panel. So we're really going to focus on two issues today, and it's going to be anchored off of a speech that Stephanie Vaking, the director of the Division of Enforcement, gave in September, really around some of the initiatives that the Commission has put in place to drive case identification and efficiency in the investigative process related to their cases. And so that what we hope to do is have a broad discussion from a lot of different perspectives, certainly from the commissions, as well as practitioners, and what are some of the things, the real life issues that we deal with every day when we're advising our clients relating to these 2 points. So just jumping into it here, Melissa, if I could just start off, if you could give us a sense of what are some of the things that the SEC is doing to try to drive a case identification.
So as usual, I have to give my disclaimer. My views are my own and not necessarily shared by the commission, the commissioners, or my fellow staff members, but glad to be here to have this discussion. Accounting and financial disclosures case remain a focus of the commission, and we have been focused on them throughout the COVID environment and continue to work on filing cases that existed pre-COVID. And then as our COVID investigations proceed, normally in this type of emergency environment, we've seen investigations start with market manipulation cases, then we see insider trading, and then we see financial and accounting fraud type matters. Those have been areas of focus for us throughout. And we're leveraging all the sources that we have, both public and non-public, as well as our technology and expertise within the building. We are looking at self-reports. Companies have been good at responding to the chairman and Hinman's request that they be proactive with regard to letting us know when issues arise. We also have TCRs, tips, and complaints. But we're seeing a lot of cases generated internally from our sister divisions, but also from the staff of the commission, using data analytics and other expertise in order to identify patterns or outliers in this area.
Excellent, thank you. It may be, Bill, if I can turn to you and open it up after you have a chance to think about this question to the rest of the panel, is given that the Commission's using a lot of these tools that, we're all former SEC alums, they probably did not exist and did not when we were there, we were a bit more vintage. But given this holistic approach where they're really leveraging public information, tweets, blogs, short seller reports, investor presentations, their own internal risk assessment tools that Melissa touched on, how, if at all, does that change how you advise your clients when you get hired to represent audit committees and companies? You're on mute, Bill.
Thanks, Steve. And as I've said many times since the pandemic, technology is not my friend. It's a great question, and I think it's important to understand that, particularly with respect to data analytics and whatever algorithms the SEC is using, it's unlikely you're going to know that at the outset of the investigation. And so whether the voluntary request or subpoena that you get at the outset, it comes to you as a result of a whistleblower or traditional market surveillance techniques or the data analytics that the Commission is employing. When obviously, if there's a whistleblower, you almost certainly would have heard about that internally. If there's a restatement or other kind of disclosure or financial reporting issue, those are going to be well known to the client. But the biggest issue when something comes across the transom that you can't tell what the source is or why you've been contacted is really client management and helping them to understand why they might have received this. And it's particularly true, at least for me anyway, when the EPS sweep was underway. I had a client who, I'm not sure why they gave guidance, because they consistently missed guidance every quarter, and they said, why are we being contacted? We clearly can't be managing earnings because we don't know how to even meet our own guidance, which is a valid question. But just working with the client both on understanding how to respond, the need to respond, and working through the disclosure issues that you face, I think, are the biggest challenges when you're contacted in that environment.
Well, maybe if I could direct the question to Dixie or Claudius, either one of you, just following up on Bill's point, does it, knowing that the Commission's using these tools and that they may be looking at your issue based as an outlier on some of their data analytics and marrying that with things like TCR information and whistleblower information, how does that change how you set expectations with your client about the investigative process?
Well, I can start, and Claudius, please chime in. I think it feels like a fishing expedition when you're in the middle of one of those investigations. The staff, for good reason, is not able to let you know if there's a whistleblower. But on data analytics, even if they tell you the pattern that they're seeing, you begin and have to go figure out what's behind the pattern. And it's very frustrating to companies. It diverts their attention from their regular work, and it's difficult. And often you end up with good, diligent companies who perhaps didn't have the record keeping that they needed to be able to demonstrate why they were doing things that they were doing. And it takes a long time to work through that with the staff. So managing expectations at the outset by helping companies know that this is going to take some time, and the more they can help the staff understand their diligence and understand how carefully they worked through their financial reporting through the years, the better. This isn't, it feels sort of like an OC exam, except with less focus and more urgency, because it's the enforcement division.
Yeah, no, thank you, Dixie. And I agree wholeheartedly. two quick points. Without a better sense from the staff as to why they came upon a case and opened a case, it's more challenging in terms of defining the scope, what the client needs to do to run down the issues in terms of internal investigation, data preservation, and things along those lines. So that becomes a challenge. And then that could conflict with what the staff wants to achieve in terms of timelines, in terms of completing the internal investigation. The other related point is remedial acts. And the less we know about what the staff's looking at and why, whether you're an accounting firm, a public company, investment advisor, is do you have the information you need to respond in a remedial sense promptly, completely, sufficiently? And so those are some of the tensions as you dialogue with the staff about why they opened a case and what's concerning them, and to try to have a productive dialogue around those issues for the reasons that I'm mentioning.
It's particularly challenging when you're dealing with issues of qualitative materiality. No one's surprised if there's a financial reporting issue that is quantitatively material, and those are easy to get your arms around generally. But in a world where a few pennies per share or at a quarter end can make the difference between an enforcement action and otherwise, it's very challenging.
That's exactly right. And every little change can be qualitatively material when you look at it through that lens, Bill. So it is very frustrating for clients in looking through that lens. I know we're going to talk about efficiencies and off-ramps in a little bit, and I'm really looking forward to all the creative ways the staff is figuring out how to end investigations early, because we want to help.
That's great. I would just say, I'm sorry these feel like fishing expeditions. The source of an investigation doesn't change how we pursue it or the information that we're providing. The intention is to partner with you because we do want to do things more effectively and efficiently. But we've been using data analytics for decades. I've been at the Commission 13 years. I've done data analytic driven investigations since the day I started here. And so this isn't anything new. And I'm disappointed to hear that people are having experiences that don't feel like the questions being asked by the staff are clearly leading to the area of interest and what we're looking for. We do want to partner with you. We are doing reverse proffers. We are doing very targeted subpoenas and other things. We're asking for you to provide us with information. We're doing earlier interviews. We want to be focused and effective from the very start of our investigations. And so the scope should be clear. Those are things we want to be dialoguing about. We want to be having a conversation. When you receive a subpoena, we often call you first and say, we're going to send over a subpoena. We're going to ask for these things. If this isn't the way to ask for it, though, let us know. Every company has its own way of doing things. With regard to remedial measures, I love remedial measures. Many of my favorite cases are what I call silent stats, where there was a correction done without ever having to file an enforcement action. So I think all of these things, whether it's a data analytic driven case or the source is a whistleblower or the source is a self-report, I think should all be part of the dialogue and the communication we're having along the way. Communication and cooperation are our goals, and the flow of information should be often inactive.
Yeah, that's excuse me. That's very helpful. One of the other things that when we're talking about financial reporting financial reporting disclosure cases is the roles of the auditor. And relative to case identification, I know that they had the Gatekeepers Initiative a few years ago, and there have been continuing ongoing enforcement efforts to hold auditors accountable. Can you comment on that a little bit, Melissa?
Of course. We're always trying to leverage scarce resources. One of the ways that we can do that is to look at the gatekeepers, whether they're accountants or attorneys or underwriters, in order to cover a broader spectrum of conduct. We will always be focused on individuals as well as the audit firms. We are very focused on looking at these auditors across issuers, across entities that are operating in our markets. And again, where we identify patterns of misconduct or repeat problems with regard to an audit from, say, 1 to 17 in one case, issuers, that'll be an area of focus for us. Again, this is an area where we're putting all of our expertise. We have OCA, we have enforcement OCA, we have task force within the building, including the fraud group. And we also have technology that the staff has developed to help us identify, again, these outliers or these patterns that are problematic in this area.
And maybe Claudius, would you like to comment on that?
Yeah, no, thank you, Melissa and Steve. Melissa, one thing, thinking about the different case identification tools that commissions used historically and to the present day, are there particular tools that you are finding more significant for purposes of finding potential audit cases? And, sort of what are those patterns or situations that you're finding? And then my corollary question is, how has your coordination with the PCOB evolved? Back in my day, we had pretty close coordination with SEC enforcement staff, across the country. I have no reason to believe that's still not the case, but it's another resource, and I'm curious how that has moved or shifted over time.
Yeah, I'll start with the latter because it's a quick answer. Yeah, we continue to have very close coordination with PCAOB. We do work to try and not have overlapping efforts. That's another aspect of efficiency for us. There are a lot of regulators in this space, and we want to be sharing the work as much as we possibly can. So that remains a strong and healthy relationship. With regard to how we're identifying these cases, I have to say our staff is terrific at looking at all of the public and non-public sources of information. They have developed tools that allow them to analyze them to find, again, broken record, outliers and patterns. But we also have a lot of whistleblowers. We have a lot of self-reports, and those are some of our best cases and the cases that we can do most quickly and efficiently.
I would just add that I have seen in at least one situation where in representing the issuer, I'm in a meeting with the SEC enforcement staff, and prior to the meeting, the staff would say, would you mind if PCAOB enforcement folks attend too? Which was kind of startling, but it does indicate that there's coordination. It just is a kind of a damper on the issuer to hear news about PCAOB review in the enforcement investigation involving the issuer.
Yeah, I think that's part of our effort to not have a duplication of efforts as opposed to having 2 interviews. Let's just do one. It's in everyone's interest. And so normally I think the interest of in the auditor and other things come up organically in an investigation and hopefully isn't usually a surprise in any way.
And then, Steve, could I, on a related point with Melissa and others, I know both the SEC and the PCOB have historically considered data on accruals in financial statements, management estimates. And my experience was there was a lot of noise in the system, a lot of false positives that some of the analytical tools would kick out in terms of accruals. And I'm just curious, Melissa, has the SEC been able to refine their analytical approach to how they look at and assess accruals for possible case development?
So we're always trying to make things better. And the staff truly, I have to give them tremendous credit, are responsive. And in those cases that we get feedback and we can learn from them, we're trying to build that in. And it's a proactive effort. It's to all of our benefit that we take the time to make our tools better, that we take the time to communicate with you. And I do invite the entire bar, communicate with us. When we have something wrong, we want to know. Our processes are built for you to give us information. We're fact-finding. We still feel like we represent everybody. You're representing just as much as every other investor or market participant. And so have your voice be heard. Reach out to us. Give us information so we can make our tools and our investigations better.
Well, maybe touching upon that point, Melissa, and I'm sure this will become a lively question with this audience. When we're thinking about the evaluation of estimates and accruals, as Claudius indicated, what does the SEC consider in determining if that estimate was made in good faith or not?
Everything.
I'm really getting at this idea that between some of the sweeps that were done at the SEC on case identification around earnings per share and earnings management, MD&A disclosures, a lot of it boils back to some basic accounting estimates, and just to get your reaction on that.
Yeah, there's not an effort to second guess here. There is a respect for good faith determinations. I think if you look at each of the cases that we've brought in this area, this is a commission that's really intending to send messages with the cases. These are outliers. These are cases that I don't think you should be surprised to be seeing in the least when you get into the details of them. And I think, if we had the time to go through each one, I could point out the things that make them cases to me that were important in the marketplace. One of the things you never see are all the cases we don't do. Never start or finish early or get down to the end and decide not to make a determination. But looking at the cases that are out there now, these are the outliers. These are the ones where the conduct justified commission action.
Steve, on that point, just to dovetail with what Melissa said on good faith approach, I think we'd all agree, and this is how we counsel our clients when they approach management estimates, is you have to have a sound process in place to come up with the estimates. You should follow the process and you should document it. And you need a really, really good reason to take exception to that process in coming up with an estimate in any given situation, because it's those exceptions that usually get companies in trouble because they don't follow process, they don't include the same stakeholders, they potentially are not transparent with their auditor about it, and they don't document it particularly well. So that's some of the ground rules that we encourage people to think about, and which we think gives them a good chance of avoiding a problem with SEC enforcement.
I think that. Go ahead, Dixie.
I think that's exactly right, Claudius, and the effort by companies to create that process is ongoing, and I think a lot of companies have been caught by surprise in the middle of investigations when the staff asks for documentation, and it's just not as robust as the companies really thought they were creating during the time. But I also think that it is absolutely the case, Melissa, that we do see cases where the staff sees enough information that they determine enforcement action is not required, even if the companies weren't perfect, and even if things could have been better along the way. So I think absolutely we're seeing reactions from the staff in support of companies' best efforts to get it right. These judgments, though, go back to what Bill was saying about qualitative materiality. And if you have a situation where quantitatively extremely immaterial amounts are being second-guessed by the staff, resources devoted to those very small entries and small accruals and small judgments just won't have been as extensive by a company as it would have been around quantitatively material items. And that's where the rub is, and that's where some of the challenges have been, in my experience.
At the risk of, and just to follow up on what Dixie said, I will say, and without disagreeing with anything Melissa said, if you're in an area that's a current priority for the commission, EPS is a good example. Everything is qualitative and material. Every control is critical, and you are facing a very challenging battle to try and persuade the staff otherwise. And by the way, they will assume hindsight is 20/20, and they will assume that you knew then what you know today, and that aspect of it, I suspect, has not changed in the 30 years that I've been practicing in the area.
So I would just say we're very focused on not having hindsight 20/20 gotcha. We are very focused on what people knew at the time. And the areas where we're looking at qualitative materiality, I think are very clear in the regulations, in the guidance, in the case law. They are things that are material to investors and no surprises. If you're required to give disclosure with regard to something, that is an area that you need to focus on. If earnings are an area of focus for a company, which they must be, and something that our SK regulations require disclosure on, that's an area where we may focus, but no surprises there. And again, I agree with Dixie. We do exercise our prosecutorial discretion routinely. We're not looking for hindsight 2020. We're not looking for a gotcha. We're not looking to second guess.
We have a couple of questions here, so let me just chime in here with a question. And this first one's not totally clear to me, so I'm just going to read it, and then we can sort of interpret what we think is the best kind of response here. It says, are there hot button disclosure and accounting fraud issues for auditors rather than issuers right now? And I'm not sure if that's getting at, are there hot button issues that you're seeing in some of your cases that the auditors need to be, if we have something we could share with the audit audience, what are some of the things they should be considering?
A couple of things come to mind immediately. One is, I think audit firms are looking more extensively at ongoing SEC investigations and are doing a 10A light kind of approach to kicking the tires on the SEC's allegations as those are ongoing, rather than waiting for an allegation or an indication of illegal activity as 10A requires. So I think auditors are looking earlier, asking questions earlier, and kicking the tires earlier on things like that. The staff also, just to follow up on what Bill was talking about, has made a big deal of companies who watch for what the market is expecting and who manage their communications with the public based on what they know the public is interested in learning about the company. That has been a focus in a number of investigations, as if monitoring what analysts are expecting is a bad thing. I think responsible companies do that and know when they're going to be reporting out numbers consistent with or inconsistent with what management is expecting. The concern arises when the entire system is designed to manipulate earnings reporting in order to meet those numbers. And when you don't have that and you are really focusing on what you're reporting so you know whether you're going to be surprising investors or not, I think that's typically the kind of situation where the tires get kicked and the commission goes away. At least that's what I'm hoping.
I think, Dixie, that you're exactly right about auditor approach. And the auditing firms, in my experience, and this is mostly on representing the companies, are laser focused on risk management on their side of the table. And the kinds of discussions that you used to have only in a big restatement case where management conduct was implicated, you're having early on. They want to know, who the custodians are, what documents you're searching for, what your search terms are. If you've done those interviews, what are the results of the interviews? What have you learned? Those don't necessarily just happen at quarter end as they're preparing their review, but can go on with more frequency. The other point I wanted to make on... I
think that's all. Go ahead, Bill.
No, go ahead, Claudius, because I can make the other point. It's different when you're done.
No, I think Bill and Dixie are spot on. I think RevRec, especially with the new standard, is going to be an ongoing focus for both the commission, for company management, for the auditors, and everyone's going to be looking for, how have those transitions resulted in different revenue recognition outcomes, different processes in terms of internal controls. And you may very well see internal control cases that the auditors have to worry about as well in certain circumstances, not just company management. The other thing I would add is just for those of you who haven't read it, take a look at the SEC RPM International case. It's an outlier, but it's a case where outside counsel conducted interviews in an internal investigation, shared those with the auditor. The court said that the investigation wasn't defined in a manner that suggested it was an anticipation of litigation, so there was no work product protection for what was shared with the auditor. The SEC got access to what the auditor had and saw, and sought and obtained through a court order the interview memoranda that everyone presumed were privileged and protected work product. And the court said that based on what the auditor was told, that information was waived by the company. And the DC Circuit denied a mandamus on it earlier this year. So again, an outlier, but something to think about as your outside counsel conducting an internal investigation to make sure you're defining what you're doing properly. So it's just another way, going to Bill and Dixie's point, auditors are being more vigilant about these 10 Cap A investigations, and they're asking to be updated on a more timely basis and on a more thorough basis about what companies are doing in response to all types of regulatory inquiries.
And one more point on that, they also are looking at disclosures. The SEC has been paying attention to performance metric disclosures in addition to GAAP and non-GAAP disclosures. And the auditors, because they associate their firm with the company's filings, are taking a look at disclosures, anything that has a number anywhere or a trend line anywhere. I'm seeing questions about.
One quick related point, Melissa, sorry. The PCOB inspectors are looking more at risk assessment, and they're not just criticizing the actual risk assessment done, but they're criticizing that certain risks were never even accounted for. And I'm expecting that auditors are going to, in response to that, are going to have to consider changes in procedures year to year as a company's business change, as revenue streams change, and try to make more timely adjustments in response to some of the PCOB's focus. Sorry, Melissa, I'll pass it on to you.
Not at all. There's way too much in there. We could do probably 2 hours on just this one part of the conversation. I agree with a lot of what has been said. I do think RevRec and the new standard is important in this area. Disclosures, known trends, areas of risk assessment are absolutely involved. And I think if you look at the COVID disclosure that has been put out by OCA, and I do recommend that to people, by CorpFin, the statements by the chairman and by the director and now former director of my division, you can get a good idea of what is going on in these areas and where our areas of focus are. Again, I mentioned we do message cases because we can only do certain cases with certain the limited resources we have. So if you take a look at the cases we're doing, I think you can see, and this is a very active area for us, where our focuses are, where people are looking, where we have concerns. And those concerns are driven by, the risk assessments done by OC, as well as what we're seeing from CorpFin, Trading and Markets, and our sister divisions. And I just wanted to reinforce something that Dixie said as well. She was talking about the difference between monitoring versus managing. And I think that when you're monitoring what the analysts are saying, that is one type of situation. When you're managing, though, something and you're trying to achieve, you have the end is determined as opposed to driven by the information in the system. That's where we see problems generally.
Yeah. Well, as you say, Melissa, we could talk about this for another half an hour. The one thing I did want to just add is, because it didn't come up, when the other thing the auditors are spending a lot of time on is the remedial steps taken, as they have to consider, their ability to on the restated financials to be able to give an opinion on that. So they've been laser focused on the remedial steps taken and what's that do, the rep chain, internal control structure, those kinds of things. So that's the only thing I'd add. But let's pivot to some of the efforts that we've touched on throughout this discussion around some of the what the SEC is doing to drive case efficiency. And so I know that, Melissa, you've touched on this a few times in some of your responses to some of the other panelists' questions. You want to give a little sense, I know Stephanie talked about it in her speech in September, a little sense of some of the larger initiatives to try to drive case efficiency?
Absolutely. We are trying to be much more targeted and to have shorter investigations. We want to partner with the bar and with those that you represent in order to focus our investigations, get the information we need in the most effective way possible. And COVID has driven us to do this in additional new ways. And we're constantly trying to refine that, as well as ask you where
we can give you more information or where you have the ability to give us more information. We're doing reverse proffers when we get to key points and inflection points in the investigations to tell you what we're seeing and why we're seeing it, and asking you to come back to us and say, you're missing this, or have you considered this, or, okay, we're right. Let's narrow the issues down to what we actually need to focus on. And we're also looking at creative ways of doing remedies, of using ICs or investigations that are done by the issuer or a market participant in order to get to places faster. Because in the COVID environment, companies are under yet an additional type of economic strain. And as much as my mission is investor protection, I'm also interested in capital formation. I'm also interested in well-regulated markets. So we're taking steps at every step along the way to be more efficient, more targeted. And, you know, cooperation is the credit that we give for that.
Let's pivot a little bit on cooperation. Dixie, from your perspective, when you're dealing with your clients, how have you seen some of the accelerated investigative techniques that the Commission's using now affect that conversation the issuers are having with the Commission around cooperation?
When we do have a really good dialogue with the staff and are able to hit the nail on the head with things that the staff is interested in following up on what they're curious about, I think it does streamline things. It just takes an enormous amount of effort behind the scenes to make sure we really get it right in that way. And in fact, in the materials for this program is an article that my partner Carmen Lawrence and I, with a colleague, just published on the topic of cooperation by the SEC, cooperation with the SEC, and cooperation credit given by the SEC. It covers the 4 fiscal years of the SEC from fiscal year 2017 to 2020, and it was published in the Business Lawyer, a business law section publication of the ABA, just this week. There will be an update coming out. But what we did was focus on how the Commission is messaging cooperation so that we could see what the positive reinforcement from the staff is about the activities in the defense bar to try to help our clients cooperate during investigations. And what we found a couple of big picture things. One is it's still difficult to demonstrate whether or how an entity's cooperation with the SEC translated directly into tangible savings that justify the cost to the entity. There are lots of reasons to cooperate, but getting that direct line of dollars is very, very difficult to see, if not impossible. We do see that the descriptions by the SEC and its settlement papers and other public statements are uneven. Sometimes there's a lot of information about cooperation. Sometimes there's not much information other than maybe a statement that cooperation was taken into effect. A couple more observations. The Spotlight on Cooperation page that the SEC maintains reflects no new cooperation agreements or DPAs or NPAs since 2016. My expectation is that there have been some, but it's hard to find them and help your client with actual factual information that can give them an understanding of why it's in their interest to embark on some of those paths. And full passes are hard to identify. As Melissa said earlier, we know they happen. A full pass is where the Commission gets to a point where they believe they could prove a violation. They may have proved a violation against an individual for aiding and abetting the company's violation, and the company does not get charged. Those are hard to find. We know they happen. We did not find any of them in fiscal 2020 through indications in the Commission's public statements. There are good reasons for that, because if you're getting a full pass, who wants to be called out as somebody who violated the law but got a full pass because you worked so hard with the Commission? But it leaves less ammunition to help clients understand what the real values are. We do, as you'll see in the article, note that the Commission has not been calling out self-policing activities, which is the kinds of things we've been talking about, the internal controls and the extensive efforts companies have undertaken in order to get it right, and why it is that in this situation they didn't get caught. We think there are lots of room for improvement in messaging in those seaboard report areas, but the seaboard report still is the pathway to cooperation with the SEC staff. You see the touch points of that throughout. And bottom line, we think we really appreciate the Commission's staff's focus on trying to message cooperation more. And we think there's a lot of opportunity to do that.
And I appreciate those comments. I think you're right when you say there are reasons why you can't see it. Often the benefit of true cooperation is you're not named. The case just never comes forward, particularly if you're doing that self-policing, because those are the cases in which, we're not doing a got you, there's not second guessing. And so you don't see them. In some ways that's success from our point of view, probably disappointing for us and for you that we can't tout those and the number of times that occurs. But cooperation takes up a large part of my day as an associate director now. It also plays very much into our efforts at being more efficient, getting things done more quickly. And so I can tell you it's a very active program. I can tell you that we are giving tremendous credit for this. And when we can give information, we do. It's often the case that the remedial steps and the details of it are not something that a market participant wants to be included in an order. We also do not want to seem prescriptive. We don't want people to believe there's only one way to cooperate. There are things we look at. Self-reporting is a key one. Self-policing is a key one. As noted in the Seaboard factors, we look at all of them. But putting the information out there are good economic and policy reasons for it to look the way that it does, unfortunately. And we're always open to other ideas of ways to get information to people, but that's where we are today.
It is true that unlike the Department of Justice, where there are pretty tight prescriptions on what outcomes are available, both on charging decisions and on remedies, the Commission has reserved basically the maximum amount of flexibility. You just don't see what you see on the criminal side. 30 years after the passage of the Remedies Act, there's really no penalty grid. And that can be frustrating as you're trying to negotiate a resolution.
And so have that dialogue with us. Again, I think communication is absolutely key, going both ways. Talk to us. We are very focused on making sure that our penalties are appropriately scaled to the conduct. It's always facts and circumstances for us, but that's a dialogue that we can and should be having routinely. And it's well taken. The forms of cooperation that we offer aren't merely dollar figures. It does have to do with charging decisions, who or what entities are charged, what charges are brought, as well as what the monetary or non-monetary remedies are that are included in a package.
Well, it would, in looking at the many years of cooperation that we reviewed, which included the ramp up to fiscal 2017, going way back, we haven't seen a true amnesty program for people coming into self-police since the 70s. There have been a number of cooperation programs that the staff Commission has announced, and the staff has proffered through the past few years, and they do help people focus on finding violations and bringing them to the staff's attention. But part of those programs is an enforcement action. So we do encourage revisiting of potential complete amnesty programs for people who bring violations that they have discovered to the attention of the staff.
And again, unfortunately, what you don't see in some ways are the successes of the times that we have chosen not to take an action. And that's not something we're in a position to publicize.
Yeah.
One quick point, Melissa, I was pleased in connection with a recent matter in front of the staff that they wanted very particular information about the cost the company incurred to self-police, self-remediate, improve processes. And it was not a casual point. They really wanted detailed information, explanations, And they told us after the presentation that it was a significant factor in making the settlement proposal they made. So not that the staff has ignored that issue in the past, but that type of focus that the staff brought to the conversation was, I thought, a very encouraging development in terms of its view on cooperation.
Yeah, I think it depends on the case. It depends on the conduct that we're looking at, the egregiousness of it, the scale, how long it's gone on. But absolutely, that's part of that self-policing piece. If you're putting the effort in, there are different ways for you to let us know that. Be proactive. Give us the information you think will help us to understand what it is your client is doing in order to meet that prong of this. We are interested in that dialogue and partnering with you to come up with the right resolution in matters short of litigation.
Yeah, so we're nearing the end of our time here, and I just want to make sure we get to a couple questions that have come in. On the question of cooperation, Melissa, this is probably for you, but others should chime in with their own experience. As discussed, cooperation could provide less chance of an action filed or potential financial penalty paid. Is it also true that non-cooperation creates a higher chance of an action getting moving forward, or a sanction being paid, or other significant increase in penalty?
So, I absolutely, I understand the question. Cooperation is an upside for you. There's a floor, I guess, we're starting from, or you could consider it a ceiling, depending on how you think of things. There's a place we're starting from, and cooperation can move you off of that place. We're not harsher as a result of not cooperating. Things may take longer. It may be more expensive. The charges may very well be different, or the remedies be different in the end, but there's no punitive measure taken as a result of not cooperating.
Okay. And then the other question, to try to get under the wire here, is how, when, and at what point do you advise issuers to disclose to shareholders that they are under SEC investigation or subpoena? And let's start with you, Bill, and then just move around the room here.
I think the disclosure question is, not to revert to what Melissa was just saying in a different context, but it's really facts and circumstances driven. And particularly, I think there's two aspects to it. One is just the fact that you're under investigation and whether that's material. But if you're being contacted in the context of a data analytic driven investigation where you don't even really know the conduct that's at issue, you can't really draft any meaningful disclosure around that. And the risk if you delay disclosure is obvious to everybody probably who's on this call, but is basically you lose credibility if you say, by the way, we've been under investigation for 6 months and we didn't tell you about it. It's really, you need to understand the scope of the problem before you tell people that you're under investigation, is my view.
Yeah. Claudius, do you want anything to add to that?
I completely agree with Bill. It's very facts and circumstances driven. There's no neat bright line rule that a Wells notice should trigger disclosure. Not to say that a Wells notice is not a significant development, but not all Wells notices are the same. Not all investigations have the same significance for an entity. And there's case law that says a Wells notice does not create per se disclosure obligations. I will say, though, companies have to be careful about what they're doing in response to investigations. If they think that they're coming close to agreement with either DOJ or the SEC on settling a matter, and they start assessing the accruals they need to take, and they have these internal decision-making processes going on those points, and then don't think carefully about whether that's triggering a disclosure obligation, that's actually where I think things can get challenging.
And if you're going to market, if you're doing a securities offering, then you're in a different environment. Yes. Completely. And Claudius is right. Everybody's looking at accruals and when you're taking a reserve. So it's going to depend a lot on the size of the enterprise. If you're a small company, the Wells notice could have very different meaning than if you're a Fortune 10 company with $100 billion in sales.
Yeah. Well, I'm getting a high sign from Bruce here that our time has expired, but I do want to thank Melissa, Dixie, Claudius, and Bill for a fantastic discussion. Thank you very much.
Perfect. Hey, thank you, Steve, for a terrific job moderating. The article that Dixie was mentioning, the new article, is in the materials, but also put a link to it in the chat if anybody wants to cut and paste that and check it out. Thank you all. Okay, so we'll be back in 5 minutes at 11:35 Eastern with our panel on FCPA trends. Be back in a minute.
Thanks.
Thank you.